Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. The federal government has approved a major natural gas expansion project in BC. Ottawa says the $4 billion Sunrise expansion program will add capacity to Enbridge's West Coast pipeline system, helping to meet growing energy demand in the province. Construction will begin in the summer.
We approve this not only because it's a good project, but because we are no longer afraid of the P word. Because we recognize that projects should be about prosperity, not politics.
Canada's February retail sales rose less than expected. Statistics Canada says overall retail sales increased 0.7% in February, coming in below forecasts of a 0.9% gain. Motor vehicles and part sales were the top performers for the month. The data suggests consumers are still spending, but cautiously. The U.S. Attorney, Jeanine Pirro says she's dropping her investigation into renovation cost overruns by the U.S. Federal Reserve. But in a post to social media, she warned she would not hesitate to restart a criminal investigation should the facts warrant doing so. Jerome Powell's term as chair is scheduled to expire May 15th, and Donald Trump has nominated former Fed Governor Kevin Warsh to replace him. Here is a look at the markets and where we stand so far on the day. The TSX Composite moving to the green, up just shy of 15 points today, or 0.4%. Having a look in the U.S., the S&P 500 up 0.7%, or 52 points. The Dow Jones is down 0.26%, or 126 points. And the Nasdaq up over 1.5%. That's a 381-point gain so far on the day. So the S&P and Nasdaq rising sharply today. The TSX has been up and down. Investor sentiment improving on more hope for a potential peace agreement between the U.S. and Iran. Let's go to Sebastian McMahon. He's senior economist, portfolio manager at IA Global Asset Management, to talk about the events of the day. Thanks for joining us today.
Hey, thank you for having me.
There are different opinions on how long-lasting the effects of the conflict will be on oil prices. What do you think?
Well, it's the key variable. So, of course, I don't have an edge on how quickly this will get resolved because it has a lot to do with how the U.S. president is thinking and, of course, politics in the Middle East. But what we do know is that the macro tailwind that we've been seeing all the way through 2025, continuing into 2026, coming from all of those synchronized rate cuts by central banks, is still blowing pretty hard. So that explains why we have such resilient markets. The global economy also is hit by this supply shock at a very resilient moment. So this is the key risk. If, let's say, the blockade continues until the end of Q3, then that would cause some very important problems for the team that we have here, that you want to stay invested. You want commodities, you want cyclicals, you want value, you want materials. At some point could run into some issues, but supply tends to find a way to markets. So far, so good. But of course, this is the key variable to a rather bullish forecast here.
Okay. Historically, Sebastian, how long would an oil shock hold down the market?
Well, historically, if you start, let's say, with the 1990s, because the 1970s were a very different animal, but with, Iraq in the 1990s, and then Afghanistan and Iraq again, and Libya, and then Ukraine and Russia. Usually, those price shocks tend to be nothing more than a blip on the price of oil historically. So it lasts a few months, and after that, again, supply finds a way to the market. If you look at the reaction of stocks, if we focus on the S&P 500, the drawdown from all of those oil shocks was between 5 and 15%, and we got something like 8-9% in the month of March. Now we're back to the all-time highs, and also after 3 months, unless there's a serious deterioration in the macro backdrop like we had in 2022, because we're coming out of COVID and central banks were then rushing to hike rates, then after 3 months, the stock market tends to be up. So that was the playbook. That was our expectations as well, that this was more a buying opportunity than a reason to reframe your portfolio. So far, so good. But again, as you mentioned very rightly at the beginning of the interview, how long this lasts will be the telling sign until the end of the year.
Are you seeing any signs or effects in earnings reports we've seen so far? And I know there have been some warnings about what's to come in the next quarters from like airlines, for example.
Yeah, if you go to sector by sector, of course, there's multiple stories there. As someone who focuses more on asset allocation, I tend to look at geographies and actually earning expectations as a whole for the broad market. So if you look at large cap, mid cap, small cap, in the US, it's been revised higher through all of that. For Canada and emerging markets, some volatility, but still very high, talking about 20-25% EPS growth expected over the next 12 months. So that's very solid. Where it's hurt a little bit more, it was in Europe, where we went from about 20-25% expectations over the next 12 months to 15, because of course they are more net importers of energy than exporters, but now it's starting to pick back up. So again, this goes towards the thesis that this is hitting the world at a very resilient moment. So, this goes in line also with the ISM and the PMIs that we're seeing in the exports from South Asia that are also reaccelerating. So again, more reasons to stay invested in risk assets.
Okay, given where we are today with the lack of clarity about when that conflict will end and already soaring gas prices across North America, what do you see central banks doing next week?
Well, central banks should stay on the sideline next week. The playbook that you get from the academic literature, and it matters because those academic researchers, usually they end up at central banks. So what they say matters. So first, it's inflation expectations. And if inflation expectations become de-anchored, they can move a little bit. But if they get de-anchored, then forward guidance is the cure for that. So next week, likely we will get a dose of forward guidance by both the Fed and the Bank of Canada, trying to just comfort markets that they will be there to do what they need to do if inflation expectations stay elevated or if inflation just moves through the system. Then after that, you look at the breadth of total CPI. So if, for example, the price of food starts to react because it costs more to ship stuff, and then you look at the momentum in core inflation, and likely this is down the road. So basically the playbook, we think the Bank of Canada stays on the sideline through the summer. And if the blockade lasts and if this becomes an issue and it fuels core inflation and the breadth becomes wider, then it could start hiking in Q4 of this year. But our base case is still that maybe it's more of a story for 2027 Q1. So we're on the optimistic side, but of course the odds are rising that the Fed and the Bank of Canada have to do something by the end of the year.
All right, you've been looking at the Bank of Canada's business survey as well. What does that tell you?
Yeah, the Business Outlook Survey to us is the key indicator because it's very broad. And if the government's plan to kickstart the Canadian economy is to work, it has to go through businesses. And businesses, they need to be confident to invest and to hire people. So, we've had 3 consecutive years, and so that was 12 quarters of net negative sentiment. And now it's still negative, but it's we can say that now it's neutral. So that's very good news here. We're far from being in the clear, but good news. And the intentions to invest in machinery, equipment, and to hire, they've all gone higher as well. So good news here, but the focus will be on that. Of course, CUSMA, but projects like the pipeline that was just announced today, those are all the things that will fuel into business confidence at some point. But we need desperately to see that to get some follow through in what we want Canada to be eventually, which is more powerful, more prosperity, and of course more independent from the U.S.
Sébastien, good to have you, sir. Thanks for joining us today.
Great pleasure. Thank you.
Canada's retail sales came in below expectations. We'll have more with an economist when we come back. Canada's retail sales rose just 0.7% in February to $72.1 billion, and that's below expectations of a 0.9% gain. Let's go to Sal Guattieri on this, Director, Senior Economist, BMO Capital Markets. Sal, thanks for your time.
Welcome.
How would you characterize this number? What does it tell you about where Canadians were in February?
Well, I think they were in a pretty good spot. I know the headline number, 0.7% increase in February, was a shade lighter than expected. And those expectations were kind of shaped by the Stats Canada's preliminary estimate of sales. But 0.7% gain is pretty good, and it follows an upward revision to even stronger sales growth at the start of the year. And that was a month where we had pretty severe winter weather. So pretty impressive overall. And on top of that, Stats Canada's initial estimate for March was pretty robust as well, up 0.6%. So it does look like this could be the first or the best quarter of retail spending in Canada since before the trade war. And that's really important because we know through last year, the economy did come close to a recession. But there were only two things that kept it out of a recession, basically stronger government spending and pretty decent consumer spending. Everything else was contracting: business investment, exports, and residential construction. So it's very important that the consumer in particular remains quite healthy this year, because we're still facing pretty well the same challenges as we did last year. And on top of that, not only just the ongoing trade war, but we now have this energy price shock that is a bit of a new challenge for the economy.
Yeah, all of this the numbers came before the conflict began, which started February 28th. Gas prices, fuel prices shooting up. You spoke about the flash estimate for March still being positive, but do you think it actually will be when you consider the price shock from gas?
No, in volume terms, it looks like overall spending, retail spending, was pretty flat, may have even declined a little bit. But the gains in volumes in the previous 2 months, first 2 months of this year, were so strong that it does look like we could see a pretty strong number for overall consumer spending in that first quarter. Now, we don't expect that to continue through the whole year. We do believe consumer spending will actually slow a little bit this year. Population growth has stalled in this country. Mortgage resets are resetting at higher borrowing costs than in recent years. So that's a bit of a drain on spending. And overall, we are seeing confidence still pretty weak in Canada, largely because of trade war concerns. So we will see consumer spending slowing this year, but importantly, we expect it to continue growing at about just over 1% rate. And that will be a key anchor to keeping the economy moving forward.
A couple of things. When you look at the report from a geographic lens, are you seeing the same sort of spending trend across the country?
For the most part, yes. The gains in retail sales that we were seeing in the first 2 months of this year were very broad-based, spread across the country and across retail outlets. I know in February, the gains were led by motor vehicles and clothing, but there were broader gains outside of those areas. So I think, again, that gives us some confidence that the consumer is still a major force propelling Canada's economy forward, at least keeping it afloat during these very choppy times because of the trade war and now the Iran war and higher energy costs. So I think there's a couple things that are keeping the consumer spending. One is wage growth. We are seeing average wages up more than 4% in the past year now. So that's still pretty decent, providing pretty good support to spending. And the wealth effect. The equity market has recovered most of its, if not all of its losses from in March from the trade war, and it's up about 7% this year, the TSX. So that's providing wealth gains, and people are spending some of those gains. So I think as long as those two factors, wage growth and the wealth effect, remain pillars of consumer spending, I think our economy should avoid a downturn this year.
You mentioned cars and parts were the big drivers for February. Is that unusual? Is there anything interesting from that point?
No, motor vehicle sales have been quite healthy right through the last year and then into early this year. They have come off their highs of previous years, but they're remaining quite healthy in this country. And again, that's a reflection of the fact that interest rates have come down pretty significantly. The Bank of Canada has cut its policy rate by more than half in recent years. And interest rates are thought to be at kind of at the low end of a neutral range, providing some modest stimulus to overall spending. And obviously, a big interest-sensitive area is motor vehicles. So that's been one area of strength right through last year, and it looks like early this year as well, motor vehicle sales.
I've got about a minute left with you, Sal. I'm just wondering if you pay attention to the e-commerce outlook there and what that says to you about the state of the consumer. Does it add much?
Doesn't add as much here in Canada as it does, say, south of the border. When you compare e-commerce sales in Canada relative to total retail sales, you're running at around 6%, in the 6% range. And that's been rising for the past decade or two, but rising very slowly. If you compare it to the U.S., though, that same number is upwards of 16% or so. So we don't buy as much stuff generally online as the Americans do, but that trend is starting to grow. But again, online sales and just physical store sales were quite healthy right across this country in the first 2 months of this year.
Okay. Sal Guattieri, got to leave it there, sir. Thank you for your time.
Welcome.
Coming up, the Canadian auto sector is showing some early signs of improvement. A closer look at what is driving the recent strength when we come back. The Canadian auto sector has had a tough start to the year, but recent data is prompting some investors to ask whether conditions may be starting to improve. One company back in focus is Magna International, after being recently upgraded to outperform at Scotiabank. We got more from Jonathan Goldman, Diversified Industries Analyst, Scotia Capital.
We upgraded the stock and effectively the sector today. Pretty out of consensus call, as you've seen all the headlines of discretionary spending may be under pressure due to inflation and oil. We probably fell into that bearish camp for the last year plus or so. It was on the higher pricing. The average car price in the U.S. is $50,000 U.S. The average monthly payment is $900. And we thought that would be a headwind to demand. And we've kind of come around to the fact that the volumes have been resilient. And one of the key reasons, as you point out, is the wealthy consumer, the wealthy household is actually supporting the auto sales. And they're driving this sort of level of volume that's sustainable. And the point in there, and also this is part of driving the prices higher, is the wealthy household, the more affluent consumer tends to go for the higher priced, higher content vehicles like the SUVs and the pickup trucks, which benefits Magna and the other North American suppliers.
That's interesting. Magna has a pretty decent franchise in SUVs and trucks.
Definitely, for sure. They're probably the leader. You mentioned they're a global company. They're the top 4 supplier in size in the world. They're number 1 in North America. And Magna actually manufactures every single GM pickup truck frame across North America. That's 1.4 million trucks. So when you look at Magna and some of the other North American suppliers, they are going to be the direct beneficiaries of any sort of tailwind that happens in the US or Canada.
What about Linamar, our other great auto parts maker? What is your verdict on them?
So we left our rating unchanged on Linamar. We're still hold, and it's the main reason there is their exposure to industrial. So that's their access segment with the aerial lift platforms and the ag market. So they're going to definitely benefit, as we believe, with Magna on the auto space. But the issue with Linamar, and they have a great franchise in both those platforms, is you may have saw last week some of the other headlines about incremental headwinds, from S-232 steel tariffs.
Okay.
Hit some of the power sports makers. And until now, Linamar was unscathed, and they still are, relatively speaking, in the auto business. But they do import product into the U.S., the agricultural equipment, the platform lifts, and that it will be incrementally impacted by the steel tariffs. So they probably can do some stuff to mitigate that, but you'll probably have a lag effect, and you could see a hit in the short term.
What about this oil shock, Jonathan? You say the numbers historically indicate that jobs are a better predictor of auto sales than oil prices?
We were just as surprised as you. I mean, oil is an input to everything in society. It raises the price of everything. Inflation is not good. It reduces your spending dollars. It obviously delays rate cuts. So we did do a lot of deep dive work into the data, and we found that oil prices alone do not impact auto sales. It's, as you mentioned, it's jobs. Obviously, if oil prices do stick around and they're longer for higher, you do get into a situation where the economy slows, and that does impact auto sales. But if you're looking at 1, 2, maybe even 3 months of oil prices at these levels, nothing much to worry about. And I guess our view is if oil could stay at 100 or below $100, you're not going to see much demand destruction in the auto industry. As I said, it's jobs, and those have been pretty resilient as well. Consumers are not, super optimistic, but they're still spending. And, it kind of goes back to my earlier comments about the wealthy consumer, and they're kind of more independent or agnostic of economic trends.
I guess we should remember fuel cost is only a portion of owning a vehicle. It's always, I don't even want to think about how much it costs to run a car. Insurance, repairs, parking, you name it.
You've seen inflation across the board, even the collision repair, the cost of insurance. But you did mention it's only one part of the car. And I think if you were to see an impact, on a near-term basis of the oil price, it would likely be a mix shift where consumers trade down to smaller, more fuel efficient cars. Part of the mix is being shifted by the wealthy consumers, as he said. But eventually, you need to replace your car. They have a built-in depreciation. They break down. So you may see people go for smaller cars. And the other thing you could see, too, is OEMs remove some of the content. So you get kind of same dollar value, but a little less car for your buck.
Just update us on electric vehicles. Obviously, the growth in sales has been disappointing. What about the States? Are we seeing, is hybrids, is that the growth area for people rather than pure EVs?
That's a really interesting question, right? So we did see the industry kind of fall off into this upwards curve of EV adoption. Started in 24, 25, and it really hit the wall, when Trump removed the EV tax credits in the US, and you kind of saw demand fall off a cliff in December. We've kind of, I would say, we're back to steady state. We're growing, but just not at the same rates we were. What's interesting is these higher oil prices does make people consider and sit down and do some of the math on whether the savings that they can generate from an EV does make sense in terms of going with what is usually a typically more expensive unit. So I would say demand is not back to the levels of EVs that we were 2 years ago, but definitely interest has peaked, I would say, in the last month or two.
Jonathan Goldman, Diversified Industries Analyst, Scotia Capital. Up next, the closing bells for Bay Street and Wall Street. Here are the closing bells for the end of the trading day. At the Nasdaq, Vital Voices Global Partnership ringing the bell. For New York, it's Sealed Air Corporation with the honor. You're watching Close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX ended the day down 9 points to 33,903. Let's have a look at the U.S. markets and see what happened there. A bit of a mixed day south of the border with the S&P up 0.8%, 56-point move on the day. But then the Dow Jones down 80 points or 0.2%. The Nasdaq moving up 398 points, 1.6% move for the Nasdaq today. Let's have a look at the movers. We're going to start here with Curaleaf Holdings, which is up 13%, so that's 52 cents a share. Cannabis stocks bouncing around after the U.S. Justice Department reclassified marijuana, made it less restrictive in the federal category. So it looks like the move will have some positives and maybe negatives for the sector as it moves on. Celestica here, a gainer of 4.4% or $23.53 ahead of their earnings, which come out on Monday. And Mullen Group also a gainer today, 51 cents or 2.6%. BMO Capital raised its rating on the company after it reported earnings earlier in the week. On the downside, we have a couple of stocks here that had been rallying but then pulled back today. So BlackBerry down over 4% or 29 cents. It did report earnings recently. Constellation Software also down today, 3.6% or $90 down on software concerns that continue. And then Rogers, which did report earnings as well, down $1.87 a share or $3.7%. Let's get to the U.S. Intel is what everybody's talking about. It is up 21%, almost 22% today, or $14.62. They had an earnings beat, and the CEO of the chipmaker says the strong performance is being driven by rising demand for its core processors. Procter & Gamble rose today after the company beat sales expectations in the third quarter. And then Newmont here we're looking at is up 8.7% or $9.64 after the world's largest gold producer reported adjusted profit that beat the average analyst estimate. The miner also said it plans to repurchase about $6 billion in shares. On the flip side, Charter Communications down almost 26% or $62.82 a share after the internet and broadband operator said it lost more customers than analysts had been expecting. The Charter sell-off spilling over to its rival Comcast, which dropped over 12% or $4 a share. And then HCA Healthcare shares dropped after the hospital owner posted adjusted profit for the first quarter that fell short of the Wall Street estimates, taking the stock down 8.8%. Canada has approved Enbridge's multi-billion-dollar expansion of its West Coast natural gas pipeline. We broke that down as to what it means for exports and energy strategy with Bloomberg's Robert Tuttle.
This marks the first really major energy project that was approved by the Carney government. As we know, Carney has made an emphasis since he assumed office a year ago of trying to push forward projects, major national projects, quicker, facilitate energy development, and ultimately, try to diversify away from dependence on the U.S. Make Canada more competitive. Today, Enbridge said in a press conference, Matthew Ackman, their head of their gas transmission, said that this was an improvement over past Canadian government approval processes, but he said there's still more room for improvement. Things should move faster. The U.S., he said, is moving faster than Canada, and a lot of investment, including by Enbridge, is being driven south of the border because of that.
Right. Although pipelines do face fights in the U.S. as well, but it is interesting, the government anxious to speed things up. And you say this is the first major energy project that the federal government has green-lighted?
Yeah, that was, of this size, certainly,
Sure.
of this size, $4 billion. Yeah. It'll add 17% to the capacity of that western gas system. A pipeline system that runs from the Montney Formation up in the northeast of BC down all the way to the U.S. border and actually supplies gas down there to the Pacific Northwest. But it will also help provide supplies for the Woodfibre LNG project. And one of the things that was noted today in the press conference was that, there's a real demand now, of course, for LNG. After the disruption caused by the Iran war of Qatar's LNG, Canada will need more gas transmission to supply LNG, both greenfield and brownfield projects, pipeline projects to supply the LNG that the world's going to need in the future. And so there seems to be more expansions on the horizon. This is just the first that's been in the works for a while, but there'll be more in the future.
Bloomberg's Robert Tuttle there. Up next, the S&P and NASDAQ closed at record highs to end the week. Traders evaluated the likelihood of the possibility of more peace talks with the U.S. and Iran. Back in a moment. Brent crude had been hovering around $105 a barrel today after spiking to about $107 to start the day. My next guest believes the global economy will experience an oil supply shock as a result of what's going on in the Middle East. Let's go to Doug Pita, Chief U.S. Investment Strategist at BCA Research. Doug, thanks for joining us today.
Thanks for having me.
So you believe there will be a supply shock. Is Asia already in that scenario, and how long before we see it in North America?
Well, it sure does feel like Asia is already in that scenario when you have school weeks being shortened, work weeks being shortened, jet fuel being rationed. Those are the sorts of things that we would expect to see as Europe begins to run out of cushions in their supply of crude oil and liquefied natural gas and other refined products like jet fuel and other derivatives, other things that come from natural gas like fertilizer, other things that come from crude oil and other petroleum products.
For North America, because both the U.S. and Canada export energy, what are the things we could do to sort of avoid or make sure that the shock doesn't deepen? Do you think the U.S. would stop exporting?
The issue with the U.S., it's funny, it's not so much a crude oil issue, but apparently our refineries that turn crude oil into gasoline, that fire internal combustion engines and automobiles, are set up to process sour crude, not the sweet light crude that is what is mainly produced in the United States. So even though you could see the United States as, since it's a net exporter of crude oil, as energy sufficient from a crude oil standpoint, crude oil doesn't make an automobile go. Only gasoline does. And we have to send our crude out elsewhere for the most part to have it refined, turned into gasoline before we can bring it back and use it for transportation. We can't just turn it into diesel fuel for trucks and ships and trains. So it's fair to say that the U.S. is more insulated. It's fair to say that Canada is more insulated, but no country is an island in the global economy. And global trade matters for every economy. And therefore, while North America will feel the impact after Asia and Europe do, it's not going to escape the impact entirely.
Okay, because we've seen that spike at the pumps for people in North America, what do you expect from the Federal Reserve then next week?
We don't think the Federal Reserve is going anywhere next week or for the next couple of meetings. Now that this supply shock is in train, is on the way, we don't believe the FOMC will be able to cut rates until it has definitive evidence that this supply shock has dissipated and that inflation is definitively on its way back to the 2% target. Now, the Fed was always sort of in that situation that it needed to be able to say, look, we're on our way to the target to justify cutting, but the existence of a supply shock has pushed forward the date when it will be able to make that declaration. So we think that the Fed is likely on hold for most, if not all, of 2026.
How would you say consumers are holding up in the U.S.? I know there's new consumer sentiment data out. I'm wondering if you can factor that in.
Sure. Look, what we found last year that was a surprise, frankly, to my team at BCA was that you don't need any job creation for households to be able to spend, because over the last 8 months of last year, May through December, the United States lost jobs, but households kept on spending. Well, they did it partially because equity prices have risen so much and home prices have risen so much, such that households had enough wealth to be able to draw on. They were able to draw on their assets and or their past income, let's call it. And they didn't need the current inflows so much to be able to keep spending. That we think is going to be a feature of the U.S. economy going forward because over the last 40 years, we've had tremendous bull markets in equities and other financial markets. And the estate tax in the United States has been rendered very nearly toothless, so that the combination of really powerful rising asset values for both financial instruments and for homes, coupled with the fact that those gains are now allowed to compound across generations with, again, the estate tax, the inheritance tax being rendered almost impotent, that has allowed households to build up a lot of wealth. And that wealth turns out to have supported spending in 2025, even when there was no job creation. Now, 3 months into 2026, we have the January, February, and March employment data. We have averaged 68,000 new jobs a month. That's not a ton, but it's a whole lot better than the 10,000 we had for the whole year in 2025. And like I said, contraction in the last 8 months of 2025. So it appears that there is some help on the way for the labor market, some help on the way for household incomes, and that should allow households to be able to keep spending such that the expansion continues in the United States.
I'm almost out of time with you, but I do want to ask you about labor because we're now seeing a pickup in the speed that the big tech companies are laying off, right? Meta is going to lay off 10% of its workforce. Microsoft is looking at buyouts in that way. How concerned are you about that part of the equation?
Look, it is very important. What we've been in over the last year is a no hiring, no firing stasis. There's been very little hiring, but counterbalancing that, there have been very, very few layoffs. You would therefore potentially get nervous when you see the headlines like Meta and Microsoft and Nike announcing these reductions in force. However, the Challenger Gray and Christmas tally of layoff announcements doesn't correlate with much of anything. So these announcements are going to go right into that Challenger Gray and Christmas tally, but they don't correlate with anything. They're not predictive. So we're just going to have to wait and see with the monthly employment situation reports, with weekly initial jobless claims and continuing unemployment claims to know if the no firing condition is still holding. For now, it's my best guess that it is. And we may, if it goes away, but no hiring also goes away, we may remain in a tolerable equilibrium where the labor force is okay and labor growth is okay.
Doug Peter, good to have you, sir. Thanks for joining us today. Coming up next, can higher commodity prices revitalize the Canadian economy? We're back in a moment. Energy prices have shot up with the conflict in Iran ongoing, which is a bonus for Canadian energy firms. But can it reignite the Canadian economy? Joining us is Matthew Arsenault. He's Deputy Chief Economist, Managing Director at National Bank Capital Markets. Thanks for joining us today.
Good afternoon.
Let's talk about the question about energy revenue. We know, obviously, some of the energy firms in Canada are enjoying that revenue boost. But do you think it will affect the broader economy in a more positive way?
In fact, that's a question everybody is asking themselves. We are a net exporters. At first, we can think that, of course, we're going to be perhaps less negatively impacted compared to other countries in the world. But we're not, in our view, at the point to say that it will be a positive for the real economy. You mentioned it, better profits for corporation in the sectors, better nominal GDP, and what it means better income for government, and at some point they will use it perhaps to spend more than they previously thought. But at the end of the day, it's in real terms, we're a bit skeptical for different reasons. First of all, when we have a supply shock like that, is the boom in prices is seen as temporary. So it's very possible that we won't see a boom in investment. And on top of that, what we mentioned in a report we published this week is the fact that when you have an increase in production or prices in the resource sector, that there's not a very high correlation with employment. So while we are a bit worried of job losses currently in the manufacturing sector, we should not count on the resource sector to compensate for this weakness in the current trade tension situation.
Okay, so let's talk about some of the counterweights on the Canadian economy, the negatives. What is the biggest counterweight you see as a drag on the Canadian economy? Is it still tariffs, for example, that have stripped down steel and aluminum companies?
In fact, what we saw in the first quarter for labor market, we lost overall 95,000 jobs in the first quarter. 1/3 of it was from manufacturing sector. And we saw retail trade, other sector linked to the consumer that are weak. So in terms of job creation, and now we know that it's going to erode the purchasing power of consumers. So we revised our inflation forecast for this year by roughly 0.3 because of this increase in prices. So that's gonna remove some purchasing power to consumers. So those are the negative impact. At the same time that some part of the economy, some government will enjoy some positive impact. Overall, consumer will have
less money to spend.
Real money in their pocket to spend.
Let's talk about housing, which has been weak across the country for some time. I know you note that in the report that you did. Do you expect that weakness to persist, and if so, for how long?
In fact, it's and that's another headwind for consumer. We have to keep that in mind. Negative wealth effect is having a negative impact on consumer at the end of the day. So we are for home sales, they are currently running 20% below their historical average, with very important weakness in BC, in Ontario as well, with cumulative real prices declining since 2022 by 20% in Vancouver, 28% in Toronto. And when you look at retail sales in Toronto, the retail sales are really weak because of that situation. So it's given that there is a headwind from population contraction, and they will be particularly acute in BC, in Ontario. We expect home price to continue to decline. So in such a situation, the Bank of Canada should be very careful before hiking rates to add another headwind to housing market, which is very weak in this country.
When you were looking at this, did you assume a relatively unchanged trade agreement with the U.S.?
In fact, in our baseline, yes, that's our assumption at this point. Marginal increase in average tariff rate is possible in this negotiation. But at the moment, we are still relatively optimistic that there won't be that much drama in that negotiation. Of course, we don't have 100% conviction on that one, but that's a risk to our scenario. But honestly, there's all those public discussion. But given that American households are already will face to an increase in inflation, I'm skeptical that the U.S. administration will add tariff on Mexico and Canada this summer on top of what they are facing consumer. So given the current context, we are relatively optimistic that Canada, Mexico will continue to be spared versus other trade partner with U.S. protectionism.
Mathieu, then from the central bank, what are you hoping for?
From the central bank, as I'll say, most economists and market is expecting no move next week. We don't expect any move by the end of the year, while market is still expecting a one rate hike. Given all the reason I mentioned, of still a weak economy, despite this boom in commodity prices, but on top of that, very weak inflation going into this oil shock in Canada. So we think that given that the Bank of Canada was successful by calming inflation in that country, now they can have the luxury perhaps to wait a bit because of this success controlling inflation.
Matthew Arsenault, I do have to leave it there, so thank you for your time.
A pleasure. Bye-bye.
Bye-bye. Up next, has the time come for tax reform in Canada? Back in a moment. Here are the stories making headlines today. Canadian AI company Cohere has signed a deal with Germany's Aleph Alpha in a bid to create an independent alternative artificial intelligence company. The company say it will function as a transatlantic AI powerhouse, anchored both in Canada and in Germany. And the German company Schwarz Group will invest 500 million euros as the lead investor in an upcoming financing round. Shares of Procter & Gamble closed higher after the company beat sales expectations in the third quarter, driven by growth in the beauty category. The consumer goods giant saw the highest organic growth in more than a year, signaling steady demand for everyday products. P&G also maintained its outlook for its current fiscal year, ending in June. Chinese exporters have started raising prices as the war in Iran drives up input costs for some goods. Companies say rising costs for plastics and other oil-linked products are forcing them to pass the increases along. After years of cheaper Chinese exports helping hold prices down, economists warn the shift could start adding pressure to global consumer inflation. A look at how we ended the week for the markets. The TSX down just 8 points today. 33,904 is where we landed. A mixed look south of the border with the S&P up 0.8% or 56 points, but then the Dow down 79 points or 0.2%, and the Nasdaq gaining 1.6%. That's a gain of almost 400 points on the day. And we are back with Talking Tax. We're asking a big question today. Is it time for tax reform in Canada? Jamie Gollenbeck joins us now to talk some more about this. He's Managing Director of Tax and Estate Planning, CIBC Private Wealth. Jamie, thanks for joining us.
My pleasure.
So industry leaders have long argued for tax reform. Do you think our system is just too complicated?
It's far too complicated for the average person. The average person does not understand their tax return. There are far too many lines on the return. There are too many credits. There are too many deductions. The rates are too high. They kick in at too low a rate. It's just not productive. We spend so many hours and times. We have to hire professionals. We have to go to Canada Revenue Agency website. The system is in dire need of a reform, has been suggested by a number of major policy think tanks over the last number of years.
Okay, when was the last big rewrite of tax law?
We didn't have a major, we've had, some reforms over the years, some, bits and pieces here and there. But of course, the last major reform happened as a result of the Carter Commission, when we had a broad reform of the entire tax system. And that occurred sort of 1972 after the sort of 6-volume Carter Commission report came out, recommending a whole bunch of changes to the tax system, many of which were adopted, that introduced things like the capital gains tax, which they didn't have before. So we've had, a bunch of tax reform since there, but really nothing major really in over 50 years. Okay,
you mentioned a number of different things that could be fixed, but what would be sort of the biggest fix you would look for in a rewrite of the law?
Well, I think that the biggest issue right now is just the overall complexity and all the specialty deductions and credits for all kinds of, very specific things. We have volunteer firefighter credits. We have teacher supply credits. Like, these are all, good causes, and there are reasons why we have all this. But would not it be better to have a more simplified system where we eliminate pretty much almost all of the credits. And instead, we're not trying to raise people's taxes here. What we're trying to do, of course, is maintain, same level of taxation, if not lower taxation, by introducing perhaps a broader general credit. So rather than having people qualify based on certain special interests and preferences, we eliminate dozens of these special interest credits. We bump up the basic amount, which is around $16,000 for every Canadian, make that a higher number. I don't know if it's 20,000, 22,000, and instead we get rid of all the stuff. We'd still leave, certain credits, maybe things like medical or charitable donations, but the majority of these credits we eliminate. They're really simplify not just the preparation of the tax return, but also record keeping and even the administration of the tax system. When you have CRA fighting people over whether or not their supplies qualify for the teacher's credit, or whether or not these items ultimately going to court, and you have judges trying to read the legislation and make interpretations sometimes for amounts that will work out to a few $100s at the end of the day. So again, my advice would be simplification of the system, starting specifically with the personal tax system.
Okay, so besides raising the amount under sort of personal income, I'm also wanting to know what that broader credit would look like. If you're ready to eliminate all the little pockets of credit, what would a broader credit look like? Under what banner would that be?
Yeah, so basically we already have that concept, right? We have something called the basic personal amount. That's the amount that every Canadian gets to earn completely tax-free. That's around $16,000. It's reduced if your income is very, very high to maybe $14,000. But, that is the value of the amount right now. There's no reason why, in elimination of all these sort of boutique credits, they couldn't bump up that number significantly. Again, I don't have the math in terms of what that would be. It would depend on the value of all these other credits. But let's say you made it $20,000 or $25,000. In other words, the average person would actually hopefully be even better off, but they wouldn't have to go through this rigmarole of qualifying and providing receipts and tracking for all these multiple credits. So it really would simplify the system by giving people sort of an expanded basic personal exemption.
Jamie, does Canada rely too much on income tax? And if you think that Ottawa does, what are the alternatives?
Yes, again, this is a much debated proposition. The biggest issue right now is that we have a very huge reliance on personal income tax and a lot less reliance compared to many other countries on things such as a goods and services tax. So GST, HST, we know the rate was lowered a number of years ago. There are many people certainly that believe on the economic side that maybe it's better to raise, let's say, the GST or HST by 1 or 2%. And ultimately, we don't want this to affect people who with lower incomes. So we introduce, they have this quarterly HST credit. It's been renamed the grocery credit. But basically it helps people in lower incomes pay for the cost of the HST. So again, if you bumped up the rate of HST, remember, you only pay it if you spend money. So if you decide to not spend money, save money, you don't pay HST, it would basically bring in billions of dollars for the government and means that you could afford to lower the personal income tax rates for everybody else. So, it's a controversial topic, but it's something that the government could look at to get more reliance on that. And again, remember, there are a lot of items that are already exempt. Housing, rents, personal rents, basic groceries that are exempt from HST, those wouldn't be affected. So that is certainly part of the reform that could be looked, just changing the tax mix to collect more money from a goods and services type tax as opposed to an income tax. Hopefully that would allow us to bring the rates down from rates that we have now at the top of over 50% in 8 out of the 10 provinces.
I do want to get you quickly on the documentation itself. And you touched on this at the start, that it's just complicated and nobody actually understands, which is why you have to go to the experts. How would you unwind that? How would you make that sort of simple, or does it have to be the way it is?
It doesn't have to be. There are many countries that you don't even file a tax return. I mean, there are opportunities there for tax reform. The government already has most of the information. If you're an employee, the government's getting copies of the T4s. If you have an investor, they're getting copies of the T5s and T3 slips. If you are contributing to your RRSP, they're getting copies of the RRSP contribution. So government has 70 to 80% of the information. So for people who are self-employed, who have expenses, that's another story. Maybe you've got, medical expenses, expenses and charitable contributions, those are sort of tracked separately. But, there really is a simplified way to do this. If the government somehow got involved, maybe they gave you a pre-printed return electronically where most of the stuff was already filled in, and you just add in, your donations or medical, and then file it all online. Wouldn't that be a way to go?
Gotta leave it there, Jamie. Appreciate your time, sir. Jamie Gollenbeck, a managing director of tax and estate planning, CIBC Private Wealth. Coming up next, Cohere making a big move in Canadian tech history. We have that when we come back. Toronto-based AI scale-up Cohere just made one of the biggest moves in Canadian tech history, announcing a merger with Germany's Aleph Alpha. The deal plants Cohere's global headquarters in Toronto and signals something much bigger than an expansion, a global play for AI power and digital sovereignty. Let's go to technology analyst Carmi Levy on this. She joins us now. Carmi, can you tell us a little bit about the German company and whether you feel it's a good fit for Cohere?
Yeah, so they're both AI platformers, so they develop large language models. Aleph Alpha's key strength here is that they've got a very deep research base and they have very strong relationships with European customers, particularly the institutional customers that work in regulated industries, which is really where Cohere plays, right? Its platforms are optimized for these environments. Turns out that's where Aleph Alpha operates as well. And so there's some really good kind of complementary skill sets here, and they will kind of work very closely together, eliminate any kind of internal redundancies, but really their culture, their client base, their technology, their approach to technology, very consistent. Just now, Cohere has an open door to expand well beyond its existing borders.
Okay, how much of this is about digital sovereignty, which we know is a topic that seems to be coming up more and more?
I think this is all about digital sovereignty or sovereign AI specifically. In fact, some of the wording in the press release from the CEO and co-founder of Aleph Alpha makes it very clear. This is about ensuring that clients have that sovereignty, have that ability to self-determine how their AI platforms operate on their behalf. Clearly, this, they're saying the United States without actually saying it. Pretty clear it's a shot across Washington's bow saying the business community is now going to seek alternatives that don't rely on American AI platforms to do the work. Instead, you take it outside the borders and you scale up globally and leave the U.S. out of it.
Let's talk about layoffs in big tech. Meta now laying off 10% of its workforce, apparently to fund the build out for AI. But is any part of this AI efficiencies already? They're gaining from AI efficiencies and don't need as many people?
That's certainly part of it, and the layers that are bearing the brunt of it are middle management. The ones who do the kinds of reporting, the kinds of oversight that AI is particularly good at replicating. Of course, the risk here is that a lot of institutional knowledge walks out the door when you get rid of these roles. But Meta is like every other major tech platform. They find themselves between a rock and a hard place. They've got to fund this AI build out to maintain competitiveness, but at the same time, those savings have to come from somewhere, and it's the middle of the workforce that's going to have to eat that. And so, this is the second significant round for Meta. They're certainly not the only ones. Oracle just went through a similar round. What's changing, though, as we move deeper into the AI impact era, is that they're no longer trying so hard to hide the fact that this is to fund AI initiatives. They need more GPU cycles. They need bigger data centers. They need more AI infrastructure. That money's got to come from somewhere, and it comes from reducing headcount one way or another.
It's interesting, though, because Oracle, we know, is deeply in debt for the build-out, but some of these other tech companies like Meta, they have money, but they still want to save money.
Yeah, it's a choice that they're making because investors are observing sort of the culture of leadership, and they're looking for them to be lean. They don't want them to stretch themselves financially. They want them to seek savings wherever they possibly can to reduce the long-term risk of this AI build-out. And certainly looking at Meta, the numbers that they've been providing up until now, originally it was 80 billion. Now they're floating numbers between 115 and 130 $130 billion. So almost doubling overnight, and the numbers continue to go up. So investors are, they're starting to get skittish as the figures get bigger, and risk mitigation ultimately comes down to reducing headcount.
Microsoft framing it a little bit differently. They're going to do buyouts. How often has this company downsized?
So they had downsized once previously, and that was the first time they've done that in their history. This is now the second significant round. They're using the term voluntary retirement, but let's be clear. It's a marketing term. It gets them to the same place. And they're essentially, it's a combination of age and years of service. If those add up to 70 and you're in senior leadership or lower, then you qualify for that. And they're hoping that about 8,700 or so of their employees will take the bait, and then they'll review, and they'll have about a month in order to respond. And then, of course, they if they don't hit those numbers, then they'll probably use a heavier hammer. This is not the last round. Microsoft tends to like to do things in multiple rounds, so they're starting with this, and depending on the kind of response they get, will determine what comes next. But let's be clear, there is going to be a next for Microsoft, and this is likely going to become an annual thing, not only for this company, but for every company, as they start to manage their headcount, their internal spend, versus what their plan is to spend on AI infrastructure build-out over the next 12 months.
Carmi, I got to leave it there, so I'm out of time, but thank you for your time. Have a good weekend.
Thanks so much, Marilla. You as well.
Up next, the obstacle to Kevin Warsh's Senate confirmation as chair of the Federal Reserve has been removed. More in a moment. A popular Bay of Fundy lighthouse won't open this season because of budget cuts. CTV's Laura Brown reports on why Cape Enrage draws thousands and what visitors will miss.
It gets its name from the way the water violently battles the reef below it. This is Cape Enrage. The current lighthouse is over 100 years old. The site offers tours, a restaurant, and zip line. You can even rappel down one of the magnificent cliffs. At least, you could.
It's kind of like getting fired, it was short and sweet.
Jim Campbell, who's worked at Cape Enrage for years and is currently on the board of directors, said he was informed by the province just last week that the not-for-profit, which runs the site's operations, would not be receiving the bulk of the funding it needs this season. They could have $30,000 of the $130,000 they normally see. Campbell says that's just not enough.
I'm saddened that something like this can't be funded.
New Brunswick's tourism department said in a statement to CTV News the situation is unfortunate and they are hoping to find some sort of a solution. The province has made cuts to museums and tourist attractions in this year's budget due to a historic $1.4 billion deficit.
I feel it's terribly sad. It's a waste of a beautiful, beautiful location for many tourists across Canada and the U.S.
Oh, Cape Enrage. My heart and soul was at Cape Enrage.
Michelle Harvey Larson owns a gallery nearby. In just a few weeks, the area comes alive, she says, with visitors. The site usually sees 20 to 25,000 tourists each year.
Cape Enrage was on the advertisement of the province. When you landed at the airport, this is who welcomed you, and this was Cape Enrage.
They're confused by the decision, if a little enraged. Laura Brown, CTV News, Cape Enrage, New Brunswick.
The U.S. Department of Justice has concluded its criminal investigation of Federal Reserve Chair Jerome Powell, which had been an obstacle to Kevin Warsh's Senate confirmation to succeed Powell. Let's go to Oscar Munoz on this, Chief U.S. Macro Strategist, TD Securities. Thanks for joining us today.
Thank you for the invitation.
So this was on the heels of one of the senators who dug in his heels during the confirmation hearing. How much pressure do you think that put on the case?
I think quite a lot. I mean, but Senator Tillis was holding the confirmation process back until the DOJ dropped the investigation case for the Fed and Powell, and just seeing that Warsh already went through the Congress this week and holding the process back, I think it played a major role in terms of dropping the DOJ probe into the Fed in order to get that process moving a little bit faster.
Okay, so talk to me about the status of the case before that. It felt like a dead case anyway, given how it was received early on in court.
Yeah, I mean, that's been the case. You heard from several Republican senators pushing back a little bit, with Tillis being the most the most vocal one, but also there were others. So I think the merits were not there. That was fairly clear. So it was just a matter of time when the Trump administration would drop that and move on in order to get Kevin Warsh confirmed.
That being said, the Department of Justice is saying it is closed, but it could be reopened. What do you put the odds at for something like that?
I think at this stage, those odds are lower. Clearly, I think the Trump administration and Jeanine Pirro want to save face, but it is a risk, right? As you say, that Pirro said she could reopen that probe or that criminal investigation at any time, and we know from Sheriff Powell that he said he had no intention of leaving the board until the investigation was well and truly over with transparency and finality. Those are his exact words at the March FOMC meeting. So there is a risk that even though the DOJ investigation may be temporarily dropped, he may want to see what happens through the third quarter and not really leave after May 15.
Did we hear from Powell today? I hadn't seen any comment, and I know he rarely comments on situations like this, but did he comment today?
No, we have not heard from him yet. We haven't heard also from Senator Tillis. We're assuming he'll drop the hold, but we haven't heard from him either. So our assumption is that if between now and the Wednesday second day of meetings from the Fed, we'll hear from Senator, and Powell will certainly be asked the question about this new development and what he plans to do going forward. So I think the focus of the attention from the next week's FOMC meeting will shift from policy decisions in the state of the U.S. economy into what's his thinking about staying at the board with this new announcement that the DOJ is going to drop the probe.
The Fed's Inspector General will continue to investigate that situation with the renovation spending. How different will it be from the criminal investigation?
Look, this is an internal investigation. It's been ongoing already. It's not something that it's just going to start now. It's just going to, I guess, just get together, gather the facts about the reasoning why costs have increased. I think it's different because there is no criminality to it, right? Senator Tillis already had offered an off-ramp earlier in the week, saying that the Senate could continue also with the investigation internally about the Fed construction costs, but clearly this is different from a DOJ and a criminal investigation that could result in jail, right, from Fed officials, including Sheriff Powell.
Okay, so let's assume that Kevin Warsh does serve as Fed chair for June anyway. Do you expect a change in tone or the rate path as a result of him being ushered in?
I don't expect that to happen, at least not at June, or at least not at the beginning of the first few meetings with him as Fed chair. I think it was going to be always hard for him to make the case for easing. We know he wants to lower rates, but given the state of the economy, the labor market seems to be holding up quite well. Inflation is going to be the major focus for the Fed over the next few months, given the oil price shock that we're going through at the moment. So I think he has to be persuade the rest of the committee of his views. And to be honest, right now, the view is that he's been critical of the Fed, and then he wants to ease policy. So he has a lot of work to do in order to convince the rest of the committee that easing is the right path for policy. And I don't think that's going to happen over the next few meetings.
And if he does not drop rates, as we know the U.S. president has been pushing for, does that then put him in the crosshairs for Donald Trump?
That's a good question and a key question. I think he has probably some leeway over the next few meetings. I think President Trump knows that the Fed chair doesn't really drive the decisions. It's a committee decision. It's a consensus decision. And at the moment, given where inflation is, I think he's going to cut him some slack. But that might change by the end of the year if we haven't really started to ease rates. Maybe Trump is going to lose his patience with Warsh as well.
Where we stand today, what does the current path look like for you?
I think that it's a holding pattern for policy in the near term. I think that's what we're going to hear from the Fed next week. Very similar message as that we heard in March as well. It is too early to make, grand statements about where policy will be moving. We're still in the early stages of the economy absorbing the oil shock, right? We already showed the March CPI with inflation spiking. I think April inflation will be strong as well. We have to see how the economy evolves on the growth side, on the spending front, on the labor market as well. So I think for now, that is the message. We do expect the Fed to start easing in September, but it's going to be a close call.
Got it. Got to leave it there, Oscar. Thanks for joining us today. Appreciate it. And that does it for The Close. Thanks for joining us. We'll see you on Monday.